Hello and welcome to the seventh session of the GCF Private Investment for Climate Conference entitled Deep Dive, Increasing Private Sector Investment in LDCs and SIDS. My name is Rajiv Mahajan. I head the project finance team at the GCF's private sector facility, and I am delighted to moderate this interesting discussion today. As many of the SIDS and LDC economies heavily depend on official development assistance and public investments, it is crucial that such public spending is spent strategically to build frameworks to trigger and attract increased private sector climate investments. GCF can play a critical role by catalyzing the shift of climate investments from governments to the private sector, which in turn would ease fiscal pressures that have significantly increased following the COVID-19 pandemic. This session will explore how GCF can play a catalytic role in enabling private sector investment flows to the most vulnerable countries in innovative climate technologies, business models, and financing instruments that are well suited and specifically tailored to the needs of the LDCs and SIDS in Africa, the Caribbean, and the Pacific. The session will begin with a scene setter of how GCF funding has played a pivotal role in enabling private sector investments in LDCs and SIDS, and will explore how, going forward, such ideas can be replicated or scaled up. The session will also explore the potential of developing tailor-made, fit-for-purpose financing modalities suited to the context of the LDCs and SIDS, including bundling projects in programmatic approaches, investment frameworks, or through equity or debt funds. The session will discuss the role that governments, regulators can potentially play to engage the domestic private sector by facilitating the creation of a favorable investment environment. The session will then go on to explore how high-risk bearing instruments and well-structured local currency solutions could prove to be catalytic to attracting private sector investors at scale in LDCs and SIDS to mitigate high-risk perceptions that are currently widely prevalent, with a view on maximizing private sector participation with a minimal market distortion. Now I have the distinct honor of introducing to you the panelists of this session. First, I'd like to welcome my colleague, Ms. Kavita Sinha, the Deputy Director of the Division of Mitigation and Adaptation of the GCF. She has a rich experience with multinational firms, international development agencies, and governments in the areas of climate mitigation, sustainable infrastructure, and in the digital utility space. Next, I welcome Dr. Lavocanto Ravello Manana, Director of the National Office on Climate Change, Carbon and REDD+ from the Ministry of Environment and Sustainable Development in Madagascar. She serves as the GCF National Designated Authority. She also teaches environment and climate change at the University of Antananarivo. Thirdly, I would like to welcome Ms. Suname Gordon, the Principal Director of the Climate Change Division in Jamaica's Ministry of Housing, Urban, Rural Environment and Climate Change. She has over 40 years experience in intersecting policy making and management in agribusiness, natural resources, and climate change. She currently serves as Jamaica's focal point to the UNFCCC, in addition to being the GCF's National Designated Authority, the Adaptation Fund DA, and the CTCN NDE. Fourthly, I'd like to welcome Her Excellency Ambassador Mrs. Diane Black Lane. She currently serves as the co-chair for the Alliance of Small Island Developing States, AOSIS, plenary for 2021 and 22, and serves on the UNFCCC Standing Committee for Finance. She heads the Department of Environment in Antigua and Barbuda, and she has previously served on the board of the GCF. Fifthly, I'd like to welcome Mr. Jeff Sinclair, Managing Director of CAMCO, a leading climate and impact fund manager and GCF accredited entity. He has 25 years experience in climate policy and investments with Standard Bank's climate finance business, and he previously worked for the New Zealand Treasury. Last but not the least, I'd like to welcome Mr. Asad Mahmood, CEO and Managing Partner of Social Investment Managers and Advisors, SEMA. He is one of the longest serving fund managers in the social investment space and has focused on attracting scaled private sector institutional investments to the social sectors. Now we proceed with the questions, and Kavita, I'd like to ask you the first question. The GCF has been at the forefront of leading climate investments in SIDS and LDCs. Could you please share with us how the GCF funds had been deployed strategically to enable mobilization of funds for financing projects in SIDS and LDCs?
Thank you, Raji, for that question. You are absolutely right. GCF not only is the largest climate fund globally, but it is also the largest funder of low emission and climate resilient development in LDCs and SIDS. As on date, GCF has committed over $4 billion in LDCs and SIDS, which is more than 41% of our total commitment of nearly $10 billion. And this mobilizes about $8 billion in co-financing. 25% of this $4 billion investments in LDCs and SIDS has come from the private sector facility, and the rest through the public sector. And among the GCF outcome areas which has received the largest share of GCF funds in SIDS and LDCs is in low emission energy access and power generation. But the share of funding towards adaptation and resilience is higher than the total share that goes into mitigation in LDCs and SIDS. Having said that, financing a rapid transition to climate resilient low emission economy will require significantly larger sums of investments in different sets of assets, and investments that address the humanitarian imperative of social inclusion and poverty elevation in LDCs and SIDS. This is not happening yet, definitely not at the time and scale that is necessary to meet the goals of a climate safe world. There are political, regulatory, macroeconomic, and technical barriers to this flow of capital to low emission climate resilient investments. These barriers translate into higher investment risk, as well as higher financing costs, which these countries are unable to, of course, bear. These higher financing costs particularly penalize the climate-friendly projects, which oftentimes have higher upfront capital requirements than conventional projects. So how does GCF, as you said, ask the question, Rajiv, how does GCF increasingly use our climate financing resources strategically to ensure that the flows of capital that are required for these vulnerable countries actually happens? To illustrate that, let me give you two examples of GCF projects that can possibly set the stage for further discussion. The first project I would like to mention is the Tanzania Agriculture Climate Adaptation Technology Deployment Program. This was a program that was approved just recently at one of our recent board meetings, the FP 179. GCF committed an investment of about $100 million to a total project size of $200 million. The program benefits 1.24 million people over the life of it, the implementation, and about 5 million people indirectly. The earlier number was for direct beneficiaries. As you know, Tanzania, and this is in Tanzania, an LDC, 27% of the GDP and 67% of the job in this country are dependent on agriculture. Both the economic value of agriculture and the livelihoods that depend on it are threatened severely by climate change. The changing weather patterns, the rainfalls, much of the agriculture in this country is rain-fed. All of these are threatened. So how GCF is creating a multi-pronged approach to ensure that this investment not only has benefits for the project here, but also has spillover effect in creating a paradigm shift. The project's funding are being used in a couple of innovations. About 10 million of the project funds are going towards paying the insurance premium of the poorest of the poor, the smallholder farmers who cannot afford this. And over a period of 5 years' time, the GCF's share of the insurance premium will continue to go down as the most vulnerable farmers become more adept at managing themselves and become financially included into the financial systems through another innovation that the project is bringing about. Another $10 million funding is creating a credit enhancement facility to enable the smallholder farmers to access credit from the partner here, which is CRDB, a direct access entity. Some of the other elements of the technical assistance is going towards creating an enabling policy and a programming, a regulatory environment, so that the effect downstream for all the people who are borrowing the funds to create technologies, the climate adaptive technologies that are necessary to become more resilient, then will be able to benefit from improved livelihoods and also improved incomes. And then hopefully, as a result of this intervention, CRDB would have created new products, which could then expand the benefits beyond the direct and indirect beneficiaries that the project is backing. So that's one project, I think, where GCF is using its financing very strategically to create a paradigm shift. The other example I would like to give is considerably smaller, and it's for energy access in a SIDS. It's in Haiti. This is a scaling smart solar energy access microgrids in Haiti. This is again another private sector project. Our partner there is NEPCO. The project investment size is small considerably compared to the one example I gave earlier. And this is $9.9 million, where GCF funds in a combination of grants and loans is enabling the crowding in of about $45.75 million of a total project size. And this is for a pay-as-you-go type of a model, where it's a prepay model of smart microgrids that is enabling people, the poorest of the poor people, beneficiaries here, who earlier did not have access to electricity, to get access to electricity and create sustainable livelihoods as a result of this program. So I hope these two examples create the baseline for discussions today of how a four-pronged approach, which is talking about transformational policy making, some climate innovation, whether in financing models or in technology models, enabling the mobilization of finance at scale, and then creating the knowledge that is necessary in the local financial institutions and the local bodies, governance, policy, and legal bodies there to enable such things to remain beyond and create the change that is needed. Business as usual is not acceptable anymore. So I'm hoping that the views and experiences of our panelists and those in the audience today will help us shape the future of GCF private sector funding to accelerate financial innovation and ensure that the benefits flow to the countries who are most in need. Over to you, Rajiv. Thank you.
Sorry for the technical issue. Accidentally mute got turned on. Thanks for that intervention, Kavita. And I'd like to shift gears a bit from a micro to a macro perspective. And I have a question for Ambassador Diane Blacklane. Diane, the AOSIS has championed debt for climate swaps for small island developing states. Where does the initiative currently stand, and how do you see swaps catalyzing private sector investments at scale from the SIDS perspective? How could the GCF potentially support developing ideas such as these and other innovative structures for mobilizing financing for the SIDS?
Thank you. So I want to start by saying that I missed a bit of the presentation. But when we looked at the presentation by the GCF, I think many AOSIS countries not in total agreement with the figures from the GCF of the impact of the amount of funding that is being provided to LDCs and SIDS. So I think it's important to state that, because it would appear that we're getting a lot of funding from the GCF when the results on the ground is not showing it. And so I think it's good to do a really clear exercise to understand. The second thing, to specifically answer your question, and it's important that the first question is also my first comment is provided, is that for small and developing states, when you do a replenishment for the GCF has an investment criteria And that investment criteria, in many sense and in terms of the results framework, favor large countries with larger impact. And this is something that AOSIS countries have seen at the GEF when the GEF started. We have not seen that in the adaptation fund, which are two other funds that provide financing. And so we feel sometimes that we get lost in the middle. So AOSIS is suggesting that, as globally, we have always been talking about this, that we are a small country, and as small countries, our per capita income has been used as a barrier for us to access financing. So one of the things that we wanted to say is that most of us on average about 60 and above, and now with COVID reaching 100 plus of our GDP in debt. Most of us have done our NDCs, and we realize as AOS that we have to have a multi-pronged approach to access finance. The GCF must provide us with financing, but the debt for climate swap can help us to leverage that financing that the GCF is providing to help us to leverage further financing from the private sector. And so that's one area that we, in addition to the other financing, but in some cases, one is dependent on the other. So where we are with that, for Antigua and Barbuda, the country I represent, we have actually just started to develop that project. And we have just engaged in found access to financing outside of the GCF that we can use to start doing these negotiations and do all the preparatory work on this. We feel we've been seeing some traction with respect to that. And we think that a debt for climate swap can solve two problems. The problems of AOSIS in terms of accessing to financing without getting into really unsustainable debt. And secondly, in our view, AOSIS would like to say to the Green Climate Fund that this is an opportunity for the Green Climate Fund private sector entity to be really innovative. Like the private sector unit of the Green Climate Fund could purchase those debt as part of their replenishment and allocate them specifically to SIDS or to LDCs. And this way we have an idea, we can work with the GCF. The GCF could significantly increase its replenishment amount, and it will have an opportunity. I know the private sector facilities struggle to work with small. I've been there when I was there, the private sector facility, and rightly so, look at big $100, $200, $300 million projects because the transaction cost other than that is really small. So I think the debt for climate swap is an opportunity for us. It's getting traction for the first time that I've seen internationally. And we think that it's a good opportunity for the Green Climate Fund to look at this as an opportunity to literally, I mean, it's a huge amount of debt out there for LDCs and SIDS. And if there's political will to address this, what better institution than the Green Climate Fund? I don't want to diss any other organization, but if you work with, like, say, the World Bank, sorry, everybody, and the World Bank, that just signal we're going to get into new debt. And so I think the brand name of the GCF would be a much better opportunity. And that is what AOSIS is counting on.
Thank you, Diane. I just want to turn to Oname, if you've got a very quick 1 minute reaction on that.
Thank you, Rachel. I think for us, if we context a lot, and let me identify with the sentiments of Diane, that the debt for environment swap in the region as an instrument has worked for us. And therefore, we have built institutions in the region on debt for environment swap. And with the inherent vulnerability of SIDS, I think this is an instrument that must be supported and to underpin our adaptation efforts in the region and to help the private sector, given the character of our private sector in the region, to do that. So it's an easy, I would say it's an easy way for the GCF to support and move the finance needle and to support the NDC implementation. So I think really, if we want to move that finance needle in LDC and SID, this is an easy way to do it. I'll stop there. Thank you.
Thank you. Thank you, Oname. Now I'll turn to the LDCs and Lovakanto. The next question is for you. which areas of priority has Madagascar identified for private sector climate investments, both in the mitigation and adaptation space, including ecosystem-based approaches for climate resilient infrastructure development? What challenges do you see in implementing these plans going forward?
Merci beaucoup de me donner la parole. Alors, Madagascar, dans son statut de pays parmi les LDC, est un pays parmi les plus vulnérables face au changement climatique. Quoi qu'il en soit, nous présentons aussi un certain nombre de potentiels pour l'atténuation du changement climatique. Si on devait commencer par l'atténuation ou la mitigation, les secteurs prioritaires de l'atténuation pour Madagascar sont l'énergie, les déchets, le transport, l'agriculture et le changement d'affectation des terres, les forêts, biodiversité et le procédé industriel. Donc, pour être plus clair, Madagascar regorge d'énergie renouvelable, pour ne citer que le solaire et l'éolienne, dont une grande partie n'est pas encore exploitée. Et grâce à ces forêts aussi, Madagascar est un pays encore puits de carbone. Donc, c'est un pays qui séquestre le carbone. Quelle est la place du secteur privé dans l'atténuation? Alors, si je devrais, par exemple, prendre le cas du secteur énergie, effectivement, le secteur privé, parfois sans le savoir, joue un grand rôle dans l'atténuation du changement climatique. Il y a des entreprises privées qui investissent, par exemple, dans la production d'électricité à partir des sources d'énergie renouvelables, comme le solaire ou l'éolien. Et après, ils vont revendre donc ces productions d'électricité à la société étatique qui est chargée de fournir l'électricité au niveau national, qui est la société appelée Jirama. Donc, ils investissent et après, ils ont un retour d'investissement. Et il y a aussi certaines sociétés qui, en parallèle, vont vendre du carbone. Donc, ils procèdent aussi à des fonds de gros carbone au niveau international par le biais de ventes sur le marché volontaire ou bien à travers des projets MDP. Et donc, il y a vraiment un rôle qui est important du secteur privé dans l'atténuation. Quoi qu'il en soit, à l'heure qu'il est, ces entreprises privées-là ne sont pas encore vraiment à jour, n'ont pas encore vraiment des connaissances approfondies en ce qui concerne les financements climatiques, comme les financements provenant du Green Climate Fund, alors qu'on le sait, si on voudrait arriver à ce fameux changement de paradigme prôné par le fonds, les appuis et les investissements publics ne suffiraient pas. Les activités menées par les ONG environnementales ne suffiraient pas, mais il faudrait vraiment une implication plus profonde du secteur privé et ce sur à quoi donc le ministère en charge de l'environnement travaille actuellement sur cette information qu'on donne au secteur privé sur les opportunités offertes par le finance climat. Concernant l'adaptation, il y a un certain nombre de secteurs qui sont prioritaires et ces secteurs-là sont parmi ceux qui sont à la base de l'économie du pays, donc les secteurs les plus vulnérables face au changement climatique. Il y a d'abord l'agriculture, avec un pays dont environ 2/3 de la population vit de l'agriculture. C'est un secteur qui fait malheureusement face aux problèmes liés au changement climatique. Il y a aussi le secteur de la foresterie, des ressources en eau et de l'approvisionnement en eau, la santé publique et les zones côtières. Concernant l'adaptation, si on devait voir donc la perception du secteur privé, il n'appréhende pas, donc ce secteur-là n'appréhende pas encore directement les liens entre leurs investissements et l'adaptation au changement climatique, étant donné que de premier abord, leur objectif, c'est d'obtenir des bénéfices et des retours sur investissement. Pourtant, avec les effets du changement climatique qui commencent à s'accentuer, le secteur privé est amené à petit à considérer ces liens entre leurs activités et l'adaptation. Si je devrais, par exemple, prendre le cas de l'agriculture, si donc une entreprise ou une société voulait investir à grande échelle dans la filière riziculture, par exemple, leur but ultime, c'est d'améliorer la production et de pouvoir vendre en quantité, en qualité de riz. Mais à un certain moment, ils vont devoir se tourner vers les solutions basées sur les écosystèmes. Parce que s'il y a déficit, par exemple, en pluviométrie, s'il y a déficit en approvisionnement en eau, il faudrait qu'il soit en amont. Donc, en amont, il y a les écosystèmes, il y a les forêts qui régulent donc l'approvisionnement en eau de tout ce système risicole-là. Et il devient important désormais d'investir non seulement dans la production, mais aussi d'investir dans ces services liés à la nature, dans l'écosystème based adaptation, pour pouvoir avoir un investissement sur le long terme et avoir donc des activités qui s'inscrivent dans la durabilité. Donc, l'enjeu, c'est vraiment cette capacité qu'on aurait à convaincre le secteur privé des opportunités offertes par les activités qui vont dans le sens de l'adaptation, l'écosystème based adaptation. Voilà ce que je pourrais dire donc sur la situation du privé par rapport à l'adaptation et à l'atténuation pour le cas de Madagascar. Je vous remercie.
Thank you, Lovokanto, and that was a good 360-degree view of the climate space in Madagascar. And that's a good segue to Jeff. Jeff, Camco has very successfully implemented the $200 million REP, which is the Renewable Energy Performance Platform across multiple LDCs in Africa, focusing on distributed renewables, livelihoods, and adaptation in sub-Saharan Africa. How can REP be instrumental in getting challenging projects off the ground? And if you want to replicate or expand REP today, what would you do differently? And then going beyond energy, how would investors such as Camco mobilize funds for investing in resiliency? And I request you to be a bit brief in your responses, keeping in mind we need to have some time for the audience questions.
Thanks, Rajiv, and I'll be quick. And thank you to the GCF team for this excellent session. Very briefly, Camco is a climate and impact fund manager working on the energy transition in emerging markets. We've been operating a bit over 30 years now, and in that time have helped over 200 projects with their finance. And those projects have had total capital expenditure of somewhere over $10 billion. We currently manage REP, a $200 million blended finance facility supporting improved livelihoods, climate resilience, and abatement through distributed energy and future smart grids. Since it became operational in 2016, the project portfolio that REP has funded has supported NDC implementation in 16 countries across Africa, provided 1.2 million people with first-time energy access, created 10,000 jobs, and mobilized a bit over $500 million in third-party funding. I thought Lovokanto's comments were really very interesting. And in fact, one of the transactions that we closed recently for REP was the solar hybridization of 3 legacy heavy fuel oil power plants in the Malil project in Madagascar. In those, REP has funded the debt on the initial quite small pilots and set up the financing structure with the intent that there will be a big scale up and replication to come, which will hopefully mobilize quite large amounts of private finance. It's a really good project and one example of how REP is approaching the task of getting challenging projects off the ground in LDCs. Many of the projects we fund are firsts. For example, the Melbuga Solar Project in Burundi, which is the country's first new power generation since independence in, I think it was 1962, and it adds around 15% to the installed capacity on the grid. We're also doing this in an off-grid context, where we've pioneered a lot of financing structures for mini-grid developers, portfolios, productive use, and enterprise development. So key elements to the approach that REP takes include a few things. One is taking risk that others don't want to, or being the first one to do something. It's hard work and it's not always comfortable, but it needs to be done. And once it's been done and it's been repeated, risk perceptions in the market change and people become more accepting of these new styles of project or finance. The second is to provide the funding that's needed and missing, so not just going in with everyone else. And that requires a lot of patience and crowding others in where we can. Another feature of REP is that it is and needs to be incredibly flexible, both in structure and terms of finance. My experience in Africa is, or in LDCs particularly, is that there is no such thing as a standard deal, and everything is complicated and highly structured. And then finally, we quite often share risk with the developers and sort of work alongside them to help the development process. So it's not just money. In terms of what we've started to do in terms of improvements, we've started to engage more with governments and other policy and regulatory stakeholders to make sure that we're aligned with their objectives and their NDCs. And I think if we were starting REP again, we would do that much earlier and more often as part of the investment process. We would also look to work with donors more closely, as they're, like it or not, they're often the entities better able to provide larger amounts of riskier and more patient capital. Going beyond energy, well, everything that REP funds already helps to build adaptive capacity and climate resilience. For grid-connected projects, more clean generation on the grid ultimately means more resilient infrastructure at a national scale and contributes to the achievement of NDCs and other objectives. And for off-grid electrification, particularly solar home systems and mini-grids, the impact is more direct, providing quite often first-time access to clean, reliable electricity, which has impacts at the local level in terms of building new resilient infrastructure and supporting local economic growth. It also has all the added benefits of improved livelihoods, education, human health, and enabling important chances for roles and opportunities of women, children, and other members of vulnerable groups. We're increasingly looking to extend this resilience activity into other sectors, including sustainable livelihoods and land use. And I think it's an area with a great deal of potential for collaborative private and public investment with, if we get the approach right. CAMCO is also launching a facility for SIDS, specifically for SIDS, called TIDES. It's an acronym, and I won't bore you with what it means. TIDES will focus initially on renewable energy and associated adaptation benefits, but ultimately we plan that it will expand its work into sustainable livelihoods, inclusive growth, and a broader decarbonisation investment theme. I think there's a really strong need and excellent potential there, actually, and am very enthusiastic about it. I'll stop there. I hope that wasn't too long. Thank you again for the time, and I look forward to some good questions.
Thank you, Jeff, and over to you, Uname. Jamaica has long been at the forefront of developing a local ecosystem, including setting up a stable regulatory regime. In that context, Jamaica's initiatives in articulating a transparent public-private partnership regime and GCF's recent readiness support on green bonds and nature-based solutions are noteworthy. could you share your experiences on Jamaica's journey and your insights in developing and operationalizing these regimes? And what are Jamaica's learnings that could potentially be replicated across other SIDS and LDCs?
Thank you again, Rajiv, and thank you for inviting us to be in this space with this group of speakers. I think as we speak as Jamaica, I would also contextualize that we speak as the co-chair of the NDC partnership, which you know, and this is a mechanism that supports across the LDC and SIDS, the private sector engagement in climate action. So I don't want that to be lost on us here. It became early to us, very, very early, that if we want the transformational change that is required, then the private sector as an essential stakeholder must be part of that journey. And so that journey for Jamaica began, I think, way back in 2012. I think in 2012, when the government of Jamaica sought assistance, I think from the IDB, I think, in designing a policy and institutional framework for public-private partnership. And in doing that work, some real weaknesses showed up itself in the work that we were doing. And chief among them, I think, was that there was limited engagement with the private sector. So we began early in the game of engaging the private sector through this institutional alignment and institutional framework and development of the policy instrument that the public-private partnership is built on. And knowingly, I don't think a lot of people know that there is now a public-private sector partnership unit established within the Ministry of Finance, and from which we take our cue. So while we understand as a region and as LDC and SIDS, the private sector and the character of the private sector in the Caribbean region, 70% of our private sector are characterized as MSMEs. And so planning within that regime has to take this into consideration. Despite this, however, we know that at the Jamaica Stock Exchange, the region itself has an active stock exchange, a very, very active stock exchange. And I think the Jamaica Stock Exchange was recognized as the best performing stock exchange, I think in 2018, 2019. And the question is, how does these small and medium-sized enterprise benefit from the capital market of which the stock exchange? But what does all of this mean for climate agenda, the public-private partnership, the MSME, and an agenda, especially the climate agenda, which is driven by the public sector, like myself as the ministry, but also within this intergovernmental process which governs climate action? I think a couple of things, very simple. If we want the private sector engagement, a public-private partnership, systematic engagement of the private sector as a credible stakeholder is key to their participation. We must have them at the table at the beginning. And I think in Jamaica, as you know, we have met with some level of success, both at the level of the GCF, but also in the work that we do as the NDA for the GCF, but as a government in engaging the private sector. And how did this happen for climate action? I think in 2018, we went to the GCF with this notion that the private sector was not as fully engaging in climate action. And we got a readiness proposal together, which we called Crowding in the Private Sector, a very successful initiative in that regard. And with part of this initiative was to do a regional scoping study. What is preventing the private sector from engagement in climate action? And we brought the private sector of the region together at the end of that study to validate that work, which was a very successful initiative as well. The private sector said, yes, this is really what is happening, and how do we participate? But we also brought what we have here in Jamaica, the Private Sector Organization of Jamaica, which is the umbrella organization of Jamaica, as a credible partner. Non-financial partner, because sometimes we will always think that the private sector has money, but they were a non-financial partner in the process because we wanted them to be at the table, and we wanted their stakeholders, we wanted their leverage within the private sector. And I think it is, in addition to the scoping study, a number of things happened. And one of the most interesting things that came out of this study and disengagement with the private sector was the study with the capital market, and looking at the capital market, looking at green bonds as a way of capitalizing, looking at the green bonds. And then the Jamaica Stock Exchange, who was also present at that, said, well, we don't know what you're talking about. we have no idea about green bonds. That was an aha moment for us as well. How could you be the best performing stock exchange, which I mentioned before, and green bonds is such a thing? So we got on our feet again, and we developed the second readiness proposal for the Jamaica Stock Exchange as the technical partner to look at the green bond market, to build the stock exchange capacity, and to also do the market research for the Jamaica Stock Exchange. And that work is ongoing. And I think one of the things we learned about that in terms of the ecosystem, that when you are planning for the private sector, they need to be at the table, because we would never have thought that the stock exchange, which is the best stock exchange, don't know anything about green bonds. The bond market is the bond market. And so I think for us, it is within the private sector that the transformation will come, but they also need capacity development themselves. I think that was one of the big lessons that we learned. The climate challenge for us is multifaceted, and the partners, the private sector, should be almost the most active partner to take the transformation forward. But the process, I think, Rajiv, has to be transparent and engaging. I think engage in the financial sector, including the central banks, I think, from some of the lessons learned, present exciting possibilities for engaging that. And we are doing work now with also greening of the central bank, which is a continuance of that work. And it presents exciting opportunity. The quick and easy lessons that we have learned, which I think we can translate across all the SIDS and LDCs, that deliberate action to crowding the private sector is a win-win for all. We as policymakers, public policymakers, have to detangle this climate speak to make it attractive for the private sector to want to engage and invest. And I'll stop there and take any questions, but a lot of work with the private sector here for us in Jamaica and across the region. Thank you, Rajiv.
Thank you, Oname. And, being conscious of time, I'll just speed ahead over to Asad. Asad, you've been at the forefront of leading your operations across LDCs in Africa and Asia. And we've seen COVID-19 affect plans of private sector investors to continue investing in priority areas such as decentralized renewables and adaptive themes centered around the productive use of clean energy. What are the top 3 adaptive measures that CIMA has deployed to keep the investment cycle going in these economies in light of COVID-19? Over to you, Asad.
Thank you very much, Rajiv. And it's a pleasure to hear people like Omar speak about the importance of the private sector, which I think is central. For us, really, the engagement has to be where there is an opportunity for us to make viable investments. So I think in the broader context of getting private sector investor, one has to be really realistic about what the profit potentials are. And once the profit potentials are there, and we see the potential of profitability, that alone is not sufficient, Rajiv. There has to be more of a demonstration, because a lot of times the private sector don't see these markets as the most attractive, especially international players coming into developing markets. So besides the potential of profit, there has to be a demonstration. And once you make that hole in the dike, then the floods can come. And you can see that in a lot of sectors that it has happened. So being pragmatic about the realities on the ground, keeping it demand driven, has led us to be practical and adapt ourselves to the need of the hour. As you know, we recently completed fund for COVID, in which private sector led, which GCF had invested $30 million. We had to do 120 loans out of this fund, and we couldn't do it in the traditional way. So we had to adapt. We had to be pragmatic, and we have to find ways to be catalytic to get the private sector engagement in this effort. It's important to recognize that the central investors in countries, developing countries, banks, 70 to 80% of their assets are in government bonds. So without having the capital to invest in these businesses that was being talked about, the private sector, you really can't see it. So if local banks that are most familiar with these environment are not willing to put their money into the private sector and keep all their money in the government sector, so then that is a real challenge, Une, as you had mentioned. So I think for us, it is what has kept us going in this difficult time and continue to push on the private sector side is to be pragmatic, realistic in our expectation, and try to be catalytic. And I'll just give one last thing. This is on the sustainability side. I think we are working on creating a first of a kind fintech mortgage company, which has green housing and which is really sort of targeting the lower income people. And that has such tremendous potential for environmental effect and raising the asset level of poor people. And that is, that market is there, but throughout the world, you can hardly find a mortgage product in that area. So thinking outside the box is also very important. I'll leave it at that. I know we are short of time, Rajiv.
Yeah, so thanks, Asad. If I can just push you on one further question, follow-up question, and a minute for you to reply. How do you look at local currency solutions and patient capital solutions at CIMA? And what best practices have you deployed in the marketplace?
Yeah, I think local currency is really important, because if you can look at the exchange rate risk in the least developed countries, they are very volatile. There are solutions to local currency that we have deployed, not just using a sort of standard FX swaps, but also in countries where there isn't a forward market to create a swap, just back-to-back transaction with local banks can also help. There are flows of capital coming in through multinationals that are looking for local currency deployment of their profits. There are ways to do and think about innovation. On the local currency side, one of the easiest things to do, but it always finds difficult, and I think development banks are doing this, is to issue bonds in local currency. So our investments coming from majority of the DFIs come in hard currency. So it's and we are not allowed to take foreign exchange risks. So we have deployed these methods of back-to-back and sort of working through local flows to protect against local currency. But it is centrally important that, especially for smaller businesses, that we don't, put the burden of the FX risk on these companies and find innovative ways to deal with it.
Thank you, Asad. And now we have less than 4 minutes left of the scheduled time in this session. And I would like to open the floor for questions. There are quite a few questions which have come through on the WOWA platform. I don't think we'll have time to take all of them. So I'll pick up one question that I see of priority. which is to any of you who would be willing to answer. So learning from the collective experiences, what could be done in the medium to short to medium term to ensure that climate investment in LDCs and SIDS accelerates globally? By climate investments, I mean private sector climate investments in SIDS and LDCs. So who would like to answer this? Perhaps Suname or Diane?
I think, Rajiv, there needs to be collective action. As I said, the private sector, especially in SIDS, the character of the private sector is so small that the uptake sometimes and the capacity for uptake is really not there. So there needs to be collective action, and there needs to be mechanisms established that can deliver at scale the emergency that exists. And I think if we marry those two, then we will see the transformation that is needed. But it cannot be the same, not fit for purpose. And let me speak in double negative here. Not fit for purpose mechanism that exists for uptake of financing that we bring to the table for this kind of private sector. It will not happen, and we will never see that happening. Just a thought there.
Diane, would you like to react?
Yeah, yes, Anime is right, but I think there's a big elephant in the room. So the uptake of climate change by the private sector globally is an issue, and it's particularly acute in small and developing states and LDCs. And AOCs have been talking a lot about one of those barriers, and that is the subsidies. And when you add the subsidies that are globally, plus the national enabling environment in all countries, including ours, it pretty much guarantees a monopoly on one type of energy system. And now we have to break that. But that has been in place for over 50, 60, 70 years, as Uname is saying. No capacity, there's a huge capacity gap now to transition to an energy system, for example, that includes renewables and plus fossil fuel. That transition is going to take a while. And the longer the transition, the more political risk and the more transitional risk. But we have not, we find in the risk that investors are looking at, and some we don't even want to talk about. Campaign financing by the fossil fuel industry is almost ensuring that what we spend more now on subsidies is more than what we spent in 2015 when we had the Paris Agreement. So there is a conversation that has to happen that we're not, none of it, you said in your introduction, one of the I think Kamko was saying that some of the conversations are uncomfortable and it takes great courage. And one of these is the subsidies that one section of the private sector gets, which is now makes it difficult for the others to get. So I think on the global scale, we have to figure out how to manage that transitional risk. Because if a country like in the Caribbean, just say we're going to turn off the subsidy and give a timeline to everybody to get ready, they will not win the next election. And that is for sure. On the issue of adaptation, I agree with Una, there's a lot of opportunities for that, but we have to structure the projects so that they understand a language. I'm not sure if you've ever seen a Green Climate Fund project document, even a simple readiness document. Nobody but you and I understand that. And then we have to translate that to the private sector. By the time we take to translate that to the private sector, they're onto some other investment. So we as a GCF, when we invest in this project space, have to make ourselves more marketable to the private sector to make them want to do business with us. No CEO in the private sector want us to come into the room. He either feel like we're stupid or he's stupid. So I think the language we use in both the adaptation and the mitigation space has to change to attract everyone to be invested on the same level.
One quick reaction from either Jeff or Asad on that point before I give Kavita the final word on this.
Okay. I think it's a very good point, particularly the different languages. I have to admit, most private sector people look at a concept note or other GCF documentation and quickly get confused about what's in there. I think just one point. I think the other thing, the other point to make about how to get things to happen is that there is a very large amount of money available for bankable projects. The problem is getting bankable projects. So getting projects and getting them to be bankable. And so I think, and that is both in mitigation and adaptation. And I think, that's where there needs to be a great deal of work done. So that, all that pension money, which has very, very low risk tolerance for good reason, can flow.
Over to you, Kavita.
Yes, Asad wants to chime in first, otherwise I can go now.
I do want to make a comment because I think we have heard a little bit about the challenges, but I think we should also focus on the opportunity. I think there is so much talk about sustainable investing in the private sector, and especially in the West, and even in developing countries, that it presents an opportunity, especially for the island nations, to create the enabling environment to bring the private sector in, because if there is profitability in an approach, and like I think Jeff said, then there is capital available that will come to it. Not so easily, there are challenges there too, but I think that we can't ignore the potential is there. I think the challenge is that we have created such bureaucracies and so much loops to get things done, ease of doing business, regulatory enabling, the ability to market, the profitability, and those elements, and educating some of it in their terms are central to the future of how we're going to get investment, private sector, and sustainable projects. Thank you, Kavita.
Thanks, Rajiv, for the last word. Excellent points made by all the panelists, I will say. The need of the hour definitely is to break the silos in which we work. Development capital will do only this, private capital will do only that, and climate finance will do only that. There is no time for that. And the more silos we can enable breaking down and creating a more integrated approach and a holistic approach where climate needs are embedded at every level of decision making, I think will enable some of these transformational shifts, definitely. I did smile when Ambassador Diane Black mentioned the language, and it's not just about interpretation between the multiple UN approved languages, but interpreting English itself. And I take that point. We do have to simplify the processes, and time has value as well. So that is another point very well taken. Private capital is fungible. They will not wait for 2 years for accreditation and 3 years for project implementation and approval. That's a very, very important thing for all of us collectively to work on how we are able to move these quickly. So I'll leave it at that.
Thanks all. And now we are coming to the end of this session, and I would like to thank all of you very much for your interest and participation in this very stimulating discussion. Wish it could go on for much longer. Please note that the video recording of the session will be posted after the event on VOVA and later on the GCF website. On behalf of GCF, I would like to thank Diane, Lovakanto, Uname, Jeff, Asad, and Kavita for enthusiastically participating in the thought-provoking deliberations. It's truly a pleasure, and we look forward to finding common ground to working with you in the future. We invite you to visit our website at greenclimate.fund/events to learn about this event and past and upcoming GCF events as well. We would like to thank the organizing team at the GCF and the interpreters who supported us today. I'd like to especially thank my colleagues, Jisoo, Ayaka, Sulbi, Ryan, Anna, Marcel, Paul, and Ani, who facilitated and worked tirelessly to make this event happen behind the scenes. Thank you so much.
Thank you.
We would also invite you to join the next session on the agenda, which is the closing session, reflections on the path to COP26 with the United Nations World Tourism Organization Secretary General Zorab Polokashvili and Panama's Foreign Affairs Minister Erika Moines. hosted by GCF Deputy Executive Director Javier Manzanares. Lastly, don't forget that you can access the list of participants, establish direct connections, create meetups around specific themes or subjects, or just have a virtual coffee break with others, all through the event app VOVA. Stay safe, healthy during these difficult times, and goodbye.
Thanks.
Thank you. Bye-bye.